Have you ever wondered why some prices skyrocket while others barely budge, even during periods of high inflation? This isn't random. It's a fundamental economic phenomenon with deep historical roots, impacting everyone from daily shoppers to seasoned investors and policymakers. Understanding this unevenness is crucial for navigating our complex financial world. Inflation is rarely a uniform event. It's a dynamic process that unfolds over time and across different sectors. New money doesn't magically appear everywhere simultaneously. Instead, it enters the economy through specific channels, then ripples outward, affecting various markets and individuals at different speeds. This historical pattern, observed across centuries and monetary systems, is key to analytical economic understanding. This uneven transmission mechanism means that the purchasing power of money erodes differently depending on where you are in the economic chain. For investors, this insight is critical for identifying sectors that might be early beneficiaries or late sufferers of inflationary pressures. For the general public, it explains why their personal experience of inflation can differ so widely from official statistics. Historically, and in modern economies, new money enters the system through distinct points. These include government spending initiatives, central bank quantitative easing programs, and the expansion of credit by financial institutions. Those closest to these initial injections, often large corporations, financial intermediaries, or specific government contractors, experience the effects first. This phenomenon, sometimes referred to as the Cantillon effect, illustrates how early recipients of new money benefit from spending it before prices fully adjust. Later recipients find that prices have already risen, diminishing their purchasing power. This creates a wealth transfer, a critical point for economists analyzing distributional impacts and for policymakers considering monetary interventions. Not all prices are created equal when it comes to their flexibility. Some prices, like those for commodities traded on global exchanges, can adjust almost instantly to new information or monetary flows. Others, however, exhibit price stickiness, meaning they are slow to change. This can be due to various factors, including long-term contracts, menu costs, the cost of changing prices, or regulatory hurdles. Wages, for instance, are often sticky due to annual negotiations or multi-year contracts. Rents, utility rates, and prices of highly regulated goods also tend to adjust more slowly. This inherent difference in price flexibility means that inflation will always manifest unevenly across different goods, services, and labor markets, creating distortions that economists meticulously track. Inflation's uneven nature is further amplified by specific supply and demand dynamics within different sectors. A sudden surge in demand for a particular good, coupled with limited supply, will cause its price to rise much faster than other goods with stable supply-demand balances. Think of recent supply chain disruptions or sudden shifts in consumer preferences. For example, a global energy crisis will disproportionately impact transportation and manufacturing costs, leading to higher prices in those sectors long before other areas of the economy feel the full effect. Understanding these microeconomic forces is vital for investors seeking to anticipate market movements and for policymakers aiming to mitigate targeted inflationary spikes. The uneven spread of inflation is not a modern anomaly. It's a recurring theme throughout economic history. During the Roman Empire, debasement of coinage led to inflation that first impacted urban trade centers and military supply lines before slowly reaching distant rural areas. Markets near mints noticed changes in purchasing power much earlier than those far removed. Similarly, during periods of hyperinflation, such as post-World War I Germany, the prices of essential goods often surged dramatically and quickly, while wages and prices of less frequently traded items lagged. This historical consistency underscores that uneven inflation is a structural feature of how money interacts with real economies, regardless of the specific monetary standard. Because inflation impacts different sectors and individuals at varying rates, it often creates a profound sense of unfairness. A household heavily reliant on goods experiencing rapid price increases, such as food and energy, will feel a much greater squeeze than one whose spending is concentrated on services with more stable prices. This disparity can lead to significant social and political friction. This differential experience is crucial for public awareness. It explains why two people can honestly report vastly different personal inflation rates, even when both are valid. For policymakers, recognizing this subjective experience is vital for crafting effective communication strategies and targeted relief measures, rather than relying solely on aggregate economic data. Uneven inflation is more than just an inconvenience. It distorts economic signals and can lead to significant misallocations of resources. It creates winners and losers, often benefiting those with assets that appreciate quickly, like real estate or certain commodities, and penalizing those with fixed incomes or savings in traditional accounts. This can exacerbate wealth inequality. For investors, uneven inflation complicates long-term planning and necessitates dynamic portfolio adjustments. For businesses, it makes pricing strategies and investment decisions more challenging. For central banks, it complicates monetary policy, as a single interest rate adjustment may not address disparate inflationary pressures across the economy effectively. In times of uneven inflation and monetary instability, gold and silver have historically served as crucial reference points. Their intrinsic value and global acceptance meant their purchasing power was not tied to the specific price fluctuations of any single good, service, or regional economy. They offered a stable measure of value when fiat currencies were experiencing uneven erosion. For investors, understanding this historical role provides context for why precious metals are often considered a hedge against inflation and economic uncertainty. They represent a store of value that transcends the localized and temporal unevenness inherent in monetary expansion and price adjustments. Inflation is often uneven because money enters the economy unevenly. Prices adjust at different speeds due to varying stickiness, and specific supply and demand conditions create localized pressures. This pattern is not new. It's a consistent feature of economic history. Understanding these dynamics allows us to approach discussions about inflation with greater analytical rigor and patience. In our next video, we'll delve deeper into historical examples of money expansion and contraction, exploring what they teach us about the long-term trajectory of inflation and its impact on societies. Disclaimer: this content is for educational purposes only and is not financial or investment advice. If this analytical exploration of inflation's uneven nature has provided you with valuable insights, please like this video. Your engagement inspires us to continue creating informative content for students, investors, economists, and the general public alike. Share your thoughts in the comments below and subscribe to our channel for more in-depth economic analysis. Thank you once again for watching. We hope you have a blessed day.